Yes, I mean, Adrian. Are you able to hear me, Adrian?
So, ED, we are to start our workshop. Maybe I will start by introducing the objective of this webinar, which we have been conducted across the region. Am I audible? ED, can you hear me?
Adrian, we can hear you well.
Okay.
Hello?
We can hear you well in Kampala.
Good afternoon. Good
afternoon.
Participant of the webinar. I think we can start our workshop, and I should start by introducing myself. My name is Adrian Njau. I'm Trading Policy Advisor with the East Africa Business Council. It has become traditional for EABC in collaboration with PwC to conduct the webinar on the pre-budget before a partner state unveiled their national budget. The main objective of this webinar is actually to look the tax proposal, focusing on the convergence and divergence of the tax measures in order to inform the business community so that they can make an informed decision when they are planning their financial year for 2024-25. And apart from EABC, we will actually hear presentation from PwC from Tanzania, which will give us the tax measures for Tanzania budget. The same will apply for Uganda, Rwanda, and Kenya. So according to our program, we are going to start with welcome remarks from John Bosco Kalisa, our Executive Director. Then we'll have a very brief presentation which will look progress on harmonization of excise duty in EAC. Then we will have now a presentation from Tanzania, Kenya, Uganda, and Rwanda on national budget proposal. Without much ado, I welcome Mr. John Bosco Kalisa, Executive Director, to welcome participant as well as to officially open the webinar. Karibu, Executive Director.
Thank you very much, Adrian. Good afternoon. Am I audible enough?
Yes, we can hear you, ED.
Okay, very good. Good afternoon, and I want to recognize the board members present, and I also want to appreciate and thank PwC for partnering with EABC. And we do have eminent panelists with us who are going to share the insight on how best the current tax measures are going to boost our economy. I want also to thank the media fraternity and all the participants across the region, and I really to appreciate you and thank you that you've been part and parcel of EABC in driving our integration agenda. On behalf of the EABC Board of Directors, I want to again thank you for taking time out of your busy schedule to participate in this important webinar on regional private sector pre-budget digest. Allow me also to extend my sincere appreciation to PwC for partnering with EABC in organizing this significant webinar as we wait for the unveiling of our government national budget started in June 2024. As you are all aware, Rwanda, Kenya, Uganda, and Tanzania will present their budget estimates on the same day this year. And this has been a customary agreed measures under our integration agenda. So the pre-budget consultation, of the ministers of finance that was held last week in Arusha has also urged partner states and member states who have not joined the same time to also prepare themselves to fast track this engagement. That is Republic of Burundi, South Sudan, Democratic Republic of Congo, to ensure that, and the Federal Republic of Somalia, to ensure that they align their fiscal year with the EAC partner states, so that they can start unveiling their national budget in the same day. So I take this opportunity to thank both the EABC Secretariat and the PW team for jointly organizing this discussion, where we will be looking at the tax measure that may impact our business. Of course, given the current global environment, which has had a detrimental impact on doing business, it is important that whatever the measures that are being discussed don't really impact the business, rather improve our environment. So during the discussion, we will ensure that we provide some substantial inputs in terms of looking at those measures which a number of states have proposed that are not detrimental to our doing business reform. We are in a very precarious situation in the sense that our government are struggling in terms of raising tax revenue to fund the growing debt deficit. But at the same time, while our revenue is very important for public goods, infrastructure, healthcare, as well as education, it is also important to ensure that the private investment is not hampered by high taxes. I've been looking into Kenya, where now they want to raise the tax revenue to GDP from 16% to 20%. That means an increment in terms of 4%. What does it mean to the private sector? I think the same measures also are being proposed across the region. How do we raise the tax rates or tax measures without jeopardizing the growth of the private sector? I think this is a very tough discussion where we need to strike balance in terms of proposing new measures, but as well as ensuring that the measures proposed don't disrupt business. And I do believe that the experts who are here are going to dive deeper into the subject and ensure that they provide a clear guidance on how best we promote our private sector, but also at the same time ensure that we generate sufficient revenue to provide public goods, as I mentioned. So the webinar is going to really look into the convergence as well as divergence of the tax measures across EAC partner states, but also ensure that they do not jeopardize the recovery agenda we have. So with those few remarks, I want to thank the PwC, I thank the EABC staff who have been working tirelessly to ensure that we have this webinar. So I wish to declare this webinar officially opened.
Okay, thank you very much, Executive Director, for the open remarks for our workshop. Now I think in terms of introduction, I think each panelist will introduce himself or herself when he actually is making the presentation. And for the time being, we are going to start with progress on the harmonization of excise tax in EAC. And since out of the 3 taxes which are supposed to be harmonized is excise duty, we find that the EAC partner state actually through Tax Policy and the Administration Subcommittee have started harmonizing of excise duty. And the last meeting for that committee, which was followed by the Committee of the Fiscal Affairs, took place in Dar es Salaam in March this year. So the progress of that particular presentation will focus on the last meeting, which took place in March 2024. To start with, my presentation actually will talk a little bit about the EAC, domestic tax policy, and then we will focus on the progress on harmonization of excise duty. And the product which are considered as mandatory and which need to be harmonized is alcoholic products, tobacco and other nicotine products, non-alcoholic beverage, and the fossil. Regarding the EAC domestic tax harmonization policy, which was actually approved and adopted by Council of Ministers in May 2019, is the policy actually which is guiding the harmonization of domestic tax in EAC. And this policy document actually provide the roadmap and also provide the context and rationale for tax harmonization in EAC, give guidance on the process of harmonization of domestic taxes, which is value-added tax, income tax, and excise duty, but also provide objective of harmonization of domestic tax in the EAC region. And also it provides two principles for approach of harmonization. The first one is a gradual approach to harmonization, where, for example, the EAC partner state agree to start with harmonization of excise duty, followed by value-added tax, and then income tax. And later on, they can also harmonize incentives. Also, another area, it provides sufficient flexible. For example, it is set tax rate subject to the agreed minimum rate. Partner state actually can set the tax rate, but they have to agree on the minimum rate for particular tax. Also, it provides the legal instrument which will be used in case of harmonization process. And it emphasizes the importance of cooperation in tax harmonization matter, where it will focus on the exchange of information instrument. And lastly, it provides the strategy for implementation and the monitoring of the policy. More important, the policy call for EAC partner test to harmonize and coordinate, among other, mandatory list of dutable goods and services, optimal rates, base of excise duty, as well as excise tax regime, which can be ad valorem or specific or hybrid, where you mix both ad valorem and specific. And as I said earlier, currently the EAC tax policy and the tax administration committee is the one actually which is doing the harmonization of excise duty with support, technical support from IMF. And the product which is focusing and which are considered as a mandatory currently is alcohol, tobacco, fuel, and non-alcoholic beverage. When it's come to excise duty, on alcohol product, according to the progress, the partner state actually has agreed a minimum harmonized rate to be set using USD per liter of 100 alcohol content. And now rate you'll find it differ from one product to another product. The rate will not require differentiating between beverage type and will not be affected by different value-added tax rates in the region, and will support neutrality in the alcoholic beverage sector. And the proposed range for alcohol actually was between USD 6 and USD 10 per liter of 100% alcohol. IMF and expert actually in the last meeting has a recommended rate of USD 8 per liter of 100% alcohol. And during the meeting, Republic of Kenya, Uganda proposed to adopt the IMF recommended rate of USD 8 per liter of 100% alcohol. And Republic of Burundi, Rwanda, and South Sudan proposed to adopt the minimum rate in the recommended range, which is USD 6 liter of 100% alcohol. But Democratic Republic of Congo requested time to conduct internal consultation. However, the United Republic of Tanzania also requested more time to finalize internal consultation and communicate her position to the EAC Secretariat. Actually, this was during the subcommittee. But when the proposal was actually moved to the Committee on Fiscal Affairs, consider those positions, and unfortunately had a divergent view as follows. Republic of Uganda will prefer to adopt the IMF recommended rate of USD 0.06 per gram, 0.06 per gram of tobacco. Kenya, Burundi, and South Sudan prefer 0.05 per gram of tobacco, while Tanzania prefer 0.014. When you go to next. Okay, when you go to tobacco and nicotine, you find that the proposed range of tobacco was between 0.04 and 0.08 per gram of tobacco. And IMF prefer 0.06, but the Republic of Kenya prefer 0.06. The Republic of Burundi and South Sudan recommended range of 0.4. And when it reached to the Fiscal Affairs Committee, it was 0.06 per tobacco, while Kenya, Burundi, Rwanda, and Sudan prefer 0.05. Tanzania prefer 0.014. Okay, on the non-alcoholic beverage, the proposed range was 0.008 and 0.0012 per gram of added sugar. IMF has recommended for non-alcoholic beverage the rate of 0.01 per gram of added sugar. But Republic of Kenya, Uganda, Burundi, and Rwanda, as well as South Sudan, adopted the IMF proposal and the recommended rate of 0.001 per gram of added sugar. The Democratic Republic of Congo has requested more time to conduct internal consultation because actually it was not attending the previous meeting. But also, the United Republic of Tanzania requested more time to conduct internal consultation, and it will communicate her position to EAC Secretariat. At the level of the Physical Affairs Committee, Republic of Kenya, Uganda, Burundi, Rwanda, and South Sudan adopted the IMF proposal and recommended the rate of USD 0.001 per gram of added sugar. And the United Republic of Tanzania, when it reached at that level, actually proposed 0.0043 per gram of added sugar. Another area which actually partner state tried to harmonize was excise duty on fossil fuel. And in that particular area, actually expert recommended the rate as follows: USD 0.35 per liter for gasoline, 0.38 per liter for diesel, 0.16 per liter of kerosene, USD 195.63 per ton for coal. And when it's come to partner state, Kenya, Rwanda, and South Sudan prefer 0.29 per liter for gasoline, USD 0.26 per liter for diesel, USD 0.15 per liter for kerosene, and USD 173.71 per ton for oil. Uganda, at the subcommittee, prefer to adopt IMF recommendation rate, except for the kerosene, which actually requested for the more time to consult. Burundi, at that level of the subcommittee, requested for START to be conducted in order to look the implication and impact of those recommended tax. The DRC also requested more time, and Tanzania had a different view when it's come to excise duty on fossil fuel, because it say those products, fossil fuel, they neither trade in the EAC, and even actually the EAC partner state do not produce those products. So it proposed to remove fossil from list of mandatory accessible products. But when it reached to the Fiscal Affairs Committee, partner state had following divergent views. Republics of Uganda, Kenya, Rwanda, and South Sudan actually prefer adoption of USD 0.29 per liter for gasoline, USD 0.26 per liter for diesel, USD 0.15 per liter for kerosene, and USD 173.71 per ton for coal. Burundi prefer USD 0.12 per liter for gasoline, and USD 0.11 per liter of diesel, and USD 0.0 per liter for kerosene. Tanzania actually insisted on their position that those products should remove from the mandatory list of the excise product. So finally, the Committee on Fiscal Affairs recommended to the Sectoral Council of Finance and Economic Affairs to direct the EAC Secretariat to seek guidance from the Council on the implementation of the Summit Directive on the sustainable financing for the EAC budget. That was another area, but actually the observation of the committee was there were divergent view on the EAC minimum excise rate for non-alcoholic beverage, tobacco, and fossil fuel as reflected above. And the meeting also had divergent views on removal of tax incentive for excise that are inconsistent with the principle Article 7 of the draft EAC Council of Directive. Because this Council Directive is the one actually will become an legal instrument when it's come to harmonization of excise duty in EAC. Those were progress in terms of the harmonization of excise duty. I think that is the end of my presentation. What I'm suggesting, we continue with the other presentation on the budget, and if there is any questions, we will come up with the question and discussion after presentation. Can I have Ibrahim from PwC from Tanzania?
Yes, Adrian, thank you. Am I audible enough?
I think now it's time for them to take lead in terms of the presentation. Karibu sana Ibrahim Mwele, sorry.
Thank you so much. Can you confirm that you can see my screen? And if I'm audible enough?
The screen is not yet shared, but you're audible.
Ibrahim, are you on?
Yes, Simon. I've just shared my screen now. It's loading, so.
Okay, we are projecting, eh?
Yep. Once it's reflected on your end, please let me know, Adrian, so that we can proceed.
Okay.
But as we wait for the content to be presented in screen, just a brief introduction from my end. My name is Ibrahim Mwele, one of the managers in tax line of service, based in Tanzania, Dar es Salaam office. And I'll be taking you through the Tanzanian aspect, but first, before we do a regional comparison in terms of the taxes that are applicable. Considering the time constraint, I'll try my level best, me and my colleagues, to be as brief as possible. In case there's be any concern or burning issues, then we can address those at the end.
Can you share the presentation if you are finding difficulty to project?
To me.
To Gabriel.
Noted. So I think Gabriel said that he. So the presentation has been shared to Gabriel, so we'll proceed shortly.
Maybe you start presenting while we are waiting the presentation to be projected, because the time is not our best ally.
Yeah. Okay, so then we can sort of kickstart the discussion in terms of what we intend to present today. So yeah, generally, in terms of a comparison in a East African space, and basically we'll be looking at the domestic taxes between Tanzania, Kenya, Uganda, and Rwanda. So coming to the corporate income tax rate, the rate is more or less similar at 30% for Tanzania, Kenya, and Uganda, but the rate is slightly lower for Rwanda, standing at 28%. That is for corporate income tax rate. In case of the employment taxes, and then the employment taxes, basically, as you're aware, there are some of the taxes that are paid by the employer and some of the taxes that are paid by the employee. In that context, in terms of the comparison, if you look at the taxes that are paid by the employers, and if you compare Tanzania, Kenya, Uganda, and Rwanda, you'll find out that the rate or the tax rate for employers, as far as employment tax is concerned, is on the higher side for Tanzanian, with effective tax rate of around 14%. And Uganda 10%, and Rwanda it's a very a lower rate of 5.3. The taxes that are paid by the employee in terms of the pay as you earn, social security contribution, and maternity leave benefit. For Tanzania, the top marginal rate that apply for those with higher income, it's on 30%. For Kenya, there's been a move from 30% to 35%. And then in Uganda, it's 40%, and in Rwanda, it's 30%. So I mean, while you can notice that from Uganda, the rate is 40%, but generally this rate only applies for, in terms of the threshold that these rates applies, it can only be only those with medium income earners and higher income earners would really be affected with this higher rate of 40%. But also something that has been a concern for a number of years, as far as the comparison of the EAC taxes in the context of employment taxes, is that for social security contribution, the rate that applies, the rate that is the contribution for social security is at 20%, where in most cases you find that the employer contributes 10%, and the other 10% is contributed by the employee. It's really on the higher side, in they put a lot of burden to employers, and making the whole process being a bit more expensive. Well, if you compare to countries like Kenya, the rate that is there that really applies. It's really on the lower side. And for Uganda, the rate is 15%, and for Rwanda, it's only at 8%. So generally, that's the comparison on the employment taxes. Okay, coming to withholding taxes. I mean, the withholding tax regime between East African countries, in terms of the nature of the payments that are really subject to withholding tax, looking at the dividend, interest, rent, royalty, service fee, and insurance premium, you get to note that generally across all East African countries, the withholding tax will be applicable in most of these transactions, but the rate tends to vary between one country to another. For each country, there are specific concern in terms of how really the applicability of these withholding taxes are, especially or in terms of an example, for example, in Tanzania, we have a 15% withholding tax on services from non-resident service providers. That for some time there's been a concern that's really a higher rate, and especially the way that it applies, it's regardless of whether the service has been performed from United Republic or Tanzania, or even in the case when it's outside. So the in terms of the rate between different East African countries, it's more or less the same. There's some sort of a difference now and there, but the nature of payment that are subject to withholding taxes, they are almost the same. Another comparison, if you are to look on the VAT, the rates that applies between East African countries, in this context, as I've said, is Tanzania, Uganda, Kenya, and Rwanda. You'll note that the VAT rate is 18% for Tanzania, Uganda, and Rwanda. The rate is slightly lower for Kenya at 16%. And as you know, this the VAT is not a union tax. So Uganda, they have, I mean, for Zanzibar, they have a lower rate of 15%. For all countries, VAT does not apply on export. And in terms of excise duty, it's almost a similar stance between different East African countries, because excise duty applies for several goods and services, and these particularly have been provided in the respective legislation for each countries. Another area that I'd also like to sort of highlight in terms of the comparison is on telecommunication and payment service. The excise duty that applies. I mean, the outlier really here is Tanzania, because it seems there's a lot of different rates that applies at different levels, and it makes the process, I mean, the whole value chain to be a bit more expensive. On financial institution, it's more or less the same. In Tanzania, there's application of 10%. In Uganda is 15% on fees and charges. In Kenya is 20%, while in Rwanda, the rate is nil. Something else in terms of comparison, and as Adrian has put some flavor on it on when he was presenting, is in terms of the budget process, the way that it is between East African countries. So most of the time with the budget process, it starts with the as far as from the point that the stakeholders are starting to be involved. The process starts from stakeholder submission to the Minister of Finance or National Treasury. In terms of that process of stakeholder submission, for Tanzania, that process starts around by February, and Uganda is between September and end of February. For Kenya, it's between September and November. Following the stakeholder submission, usually the discussion are held on those submission. For Tanzania and Uganda, those discussions most of the time are completed by the end of March of a respective year, and in Kenya by December, that's when the discussions normally are being finalized. The main concern that has been between the discussion and the time that the finance bill is issued If you compare between East African countries, you'll note that Uganda and Kenya will tend to issue the finance bill earlier. For example, as we speak now, ahead of this budget reading, Uganda and Kenya already have the finance bill, so at least they have an idea in terms of what will come in terms of the changes in tax. In Uganda, I think from around end of March, they already had a finance bill. And in Kenya, from early May, they already had by early May, they already had they already had their finance bill. So there's enough time for stakeholders to be able to go through the finance bill in case there's some suggestion or the stakeholders' involvement. It means there's ample time for them to also be involved in the process. But in Tanzania, you'll note that up to this time, the finance bill has not been published or has not been issued. And usually, and in terms of expectation, is this will come from mid-June. So you get to note, since the Finance Act, or the effective date for changes that are implemented by the Finance Act is 1st July, the stakeholders will only have 2 weeks, which is it's a very, very limited time in terms of having a positive or constructive engagement between stakeholders and the government in terms of to discuss the finance bill, in case there are things that really will not work, in case Finance Act suggests some of the things that might require changing the systems, as you could have seen the change that happened in the past on the telcos, the issues around the primary data servers. The time is very, very, very limited to have those progressive stakeholders engagement. So that's more in the context of regional comparison. Tanzania specific. Okay, in the context of Tanzania specific, so as I've mentioned, as of now, and this will be the difference between with other countries, and you see it's more like a different process for Rwanda, because for them the budget process will mainly be focusing on the fiscal issues rather than tax issues. In terms of the changes that come into play on tax basis, it's usually based on the medium-term revenue strategy that they have. So their process is a bit different compared to other East African countries in this case. But as I've mentioned, in terms of the budget process, the budget process in the case of Tanzania, it gives a very small window in case of stakeholders engagement because of late issuing of the finance bill. So that's one of the area that really has been, we have been trying to, as stakeholders, trying to push the government to see if there's something that can be done. At least there could be enough time. So you see, even in the context of Tanzania, in this case, what we present here, it's really based on the proposals, which is somehow different for countries like Kenya and Uganda. What they will present, it's more what's already in the bill and what's the expectation on their views on that. Another issue that's contentious is on tax deposit waiver request. As you're aware, the tax dispute resolution process in Tanzania, prior to filing an objection against tax assessment, you're supposed to pay a tax deposit, and the taxpayer has a right to request for waiver of tax deposit. But there's no really clarity on the process to follow in case there's any dispute. In this case, where the commission or the TRA rejected the request, there's been varying decision at different levels. And so one of the things that we think will be good is to make sure that the Tax Administration Act lay down a clear fact in terms of what to follow in case of a dispute. And something else is on the clarity on time for objection admission. The following in terms of tax dispute resolution process, after you have filed the objection, the Revenue Authority will have to admit the objection. Although there's a reference to admission of objection, there's no really clear guidance in terms of what really is the process. What we have seen in practice is TRA have been issuing the letter confirming admission objection. So it's clear from there that your objection has been admitted. And in case of the 6-month timeline, then you know from what time exactly you can start counting. But this has not been the case in all TRA offices. There's a challenge, especially with the regional offices, where in some cases they don't really issue a letter to confirm admission. And considering there's no that clear guidance, so it has not been clearly put in the act in terms of the requirement for the TRA to issue this admission. So this is one of the proposal that was sent. And something else is on the 6 months timeline on the deemed assessment. These changes come a few years ago. It was a welcoming move in terms of a change to see that the process, the dispute resolution process, at least at the TRA level, get expedited. But the way that the legislation has been drafted is after the 6 months, the assessment will be deemed to be determined, but it more like determined in the way that the assessment has been issued. So we think the reasonable or the amendment that needs to be made in this context is to see that if the taxpayers has already filed an objection against an assessment and the TRA are the one who have not responded and determined the objection, then the deemed assessment should be in line with the objection rather than reinstating or rather confirming the position on the assessment which has been objected. Something else from tax administration point of view is to shorten the time that it takes to get VAT refunds. Recently, there's been an improvement in terms of the time that it takes to process the refund, but I think this is something that can be tabled in a way that really it takes, there's a clarity in terms of the time that it takes for taxpayers to get the VAT refund. On the income tax space, just highlighting on the key issues only because of the time, is the rationalization of the taxes on SME. So the idea is to have a specific definition of SME, let's say based on the turnover, and then a lower rate to apply. Based on the 6-month report of up to December 2023, more than 80% of the tax has been collected from the large taxpayers. So I think to have a rationalization of taxes for SME or to recognize them and having like these incentives like a lower rate or exempt them from SDL is something that's going to improve the voluntary compliance. And something else quickly to touch base on, which is we think it's a key issue is on the foreign exchange. This to follow as of now, the deductibility of foreign exchange differences on realization basis. But this really, from practical point of view, and even if you speak with taxpayers, this really is a challenge because items like working capital is very, very hard to track its realization, and the approach that the Tax Revenue Authority have been taking in terms of just to substantiate realization, it leads sometimes to unnecessary adjustment, which is not fair. So to some extent, we think other than long-term loans, I think the deductibility for the foreign exchange should be on accrual basis. Just the last item, which is also key, which I'll touch base on. The others I've not explained. We'll share the slides later, and you'll be able to sort of make reference on. It's the amendment of single installment tax provision to align with the economic and legal reality of how the transaction is concluded. The recent change that has been made a few years back, it's in a way, in some extent, that once you have signed you have entered into contract or an agreement, you have signed it, to some extent it triggers. But there are other transactions that really, as much as you'd have a signed contract, it's subject to regulatory approvals. So it's really the way that the section is where it doesn't align with the economic and legal reality of how transactions are concluded. So this is one of the another key changes that we sort of in terms of the proposal. If you go to SDL minor, there's been progression reduction in terms of the rate. Currently is 3.5, but the idea is, and the proposal is to have 3%, and possibly in order to reduce the administration burden, to sort of see if that can be sort of allocated between the VETA and WCF, so that in a way you abolish the administrative burden for WCF. I think those are the key issues. Considering time, I think we can move to VAT, and my colleague Elijah Sanga will be taking you through the proposal from Tanzanian point of view. Thank you.
Thank you, Ibrahim. So with respect to VAT, there are a couple of proposals by stakeholders in different industries to see how they can harmonize the VAT registration in Tanzania, and in particular, how we can use VAT to sort of stimulate business in Tanzania. So the first one is with respect to the tourism industry. As you may be aware, when you're visiting most of the government parks, for instance, the Tanapa parks, you will be required to pay the concession or park entry fees, which in the eyes of stakeholders, those are government revenue. But the thing is, on top of that, the park fees usually attract VAT at a rate of 18%. And in our eyes, we see that to be tax on tax. And the proposal is to see if VAT can be left on other tourism services. But in terms of the park fees, which are more or less similar to levies paid to the government, VAT should be exempted in such fees. The second one is the exemption on smartphones. As you may be aware, about 2 years ago, there was the exemption on smartphone to see how they can boost maybe the smartphone penetration to Tanzania who do not have sufficient income to afford smartphones. But that decision was reversed after 1 year. But the view is maybe the market was not given enough time for the prices to adjust because the government is saying there was no reduction in prices even after the exemption of VAT on smartphones. So the idea is, can we still exempt smartphones and give it time for the market prices to reflect that change, and maybe VAT can be left on feature phones. The other one is to support the environmental conservation. So there's quite a new industry which is now sort of picking up in Tanzania in the area of carbon emissions. In particular, verified emissions and the carbon credit sales. At the moment, there's no exemption in those services. And we see that as much as some companies are trying to invest in this space, maybe that exemption will sort of boost major companies to come and invest in Tanzania and continue to harvest the carbon credits, which indirectly sort of enhance the environmental conservation as well as economic and the social impact that this kind of project have. The other one, which also we have seen a change in a couple of years, is on VAT deferment. So this actually led to a scheme under the VAT law, which allows companies who usually import significant capital items. So to sort of support business in terms of cash flow, the law, what it does is it deferred VAT payment on importation of certain capital item, so that you don't have to pay the government when you're importing those capital items. So as much as there's VAT, that VAT will be deferred to a later time. And in case of Tanzania, if you keep using the asset for a period of 10 years, that VAT is actually no longer payable. So it's some kind of a delayed exemption. But over the years, we have seen that scope being reduced. So at the moment, there's a very few items that you can enjoy VAT deferment on, which now leave a challenge in terms of you can still be importing a capital item, which is quite significant. But in terms of you getting the VAT deferment, you're no longer covered just because of that change. And the idea was maybe to support the local manufacturers, but we see that at the moment, maybe we don't have sufficient manufacturers of those capital item in Tanzania. And maybe the change has been quite premature. So the idea is, can we please look into that and maybe still allow VAT deferment for those key capital items from outside Tanzania? The last but not least on VAT is regarding VAT refunds. So recently we have seen challenge with companies under exploration, especially in the mining sector, because it usually takes some time for companies to finish the exploration, maybe until when they move into production. During that time, they incur significant VAT. So the question is whether can they get refunded the VAT that they've incurred, even though maybe they have not yet started the operations. So currently, there seem to be different view on whether they can get a refund or not, but to support the industry, and given that it usually takes a long time for those kind of projects to start production, maybe the idea is, can we allow them to get a refund, because a lot of cash will be sort of tied in terms of VAT refund, which could have been used with the companies to sort of enhance their exploration activities and maybe discover more mining, which will lead into the production. In terms of excess duty, as maybe aware, our excess duty is very old, at the moment over 30 years old. And I think if you look at the provision in terms of day-to-day operation of the law, you find that most of the clauses are actually outdated, considering the environment that we are operating in. So the main proposal is, can the government look into changing the entire legislation, sort of it incorporate the provisions that are relevant to the current environment. If you look at other legislation, most of them, I think the oldest at the moment is the 2004 Income Tax Act, and most of them are actually very, very recent. If not, most of the provisions have been updated. But the excess duty, on the other hand, is a bit different. For once, it was introduced to cover only goods. So most of the provision only discusses about goods. And then services was introduced later on, but it only just on the imposition section. But other sections which are very critical in the operation of that legislation seem to discuss only goods and does not cover services. So that's a change that we see, and the proposal is the government to look into sort of enhancing the legislation or completely introduce a new excess duty act. In terms of specific changes that may be quick win for the government is one, as you have seen what Mwele was presenting, our telco sector is heavily taxed. There's quite a number of taxes in that sector. So the proposal, can the government consider reducing the rate of excess duty from 17 to 10, being the idea being reducing cost and maybe improve the penetration of transportation services in Tanzania. The second one is, as maybe aware, excess duty is tax on consumption. But currently we have, especially in the telecom sector, companies that are intermediaries. So they're not really consumers, but maybe they buy data for subsequent sale. But the way the law is seem to only cover goods in terms of the intermediary. But if you are dealing with services, the question is whether, even if I'm buying services for subsequent supply, should I be accounting for excess duty or should I be charged excess duty? So we believe that the need to sort of provide a clarity in that area, because in principle, excess duty should only apply once where the service is being consumed. But if you're an intermediary, the idea is that you should not be within the scope of that excess duty. The last one is on export of services. So similar, like I said, the legislation seems to discuss only goods, but it's quiet in terms of services, which sometimes bring into challenges in terms of practicality. You may be exporting a service, but then because the law does not explicitly exclude the export of service from excess duty, then the question is whether are we saying we'll be now starting charging excess duty to non-residents who do not consume those services in Tanzania. So regarding the digital services, recently, back in 2022, the government introduced a simplified VAT registration for non-residents who supply electronic services in Tanzania. So it has been a good move, and we have seen quite some movement in terms of non-residents who are registering under that simplified VAT for non-residents. But the challenge, one, is there's no threshold. So even if you have 2 customers in Tanzania or 1 customer, the regulation seems to indicate that you are required to register in Tanzania. So we believe there has to be clarity in terms of threshold, if possible, aligned to the general rules of threshold in terms of VAT registration. Another one is the non-residents are not allowed to claim any input tax, even though they're paying out for VAT in Tanzania. So that one also is a proposal for the government to reconsider. Regarding mobile money and levy, you may be aware that this was introduced about a couple of years ago, and then a year later it was reduced. But we believe, considering how much taxes are already in our money transfer, which may be affecting our financial inclusion agenda, maybe it's time the government consider removing these levies completely, because we already have VAT and the excise duty on money transfer, which is already making the service quite expensive. Regarding civil service levy, there's a bit, because this levy is paid to each municipal, and for companies that are operating throughout the country, it becomes a challenge to see how are they now required to sort of comply with each district in which they operate. So last year, the government considered a proposal by Telkom to allow them to only pay the service levy centrally, and then it's the government that now is going to distribute that levy across all jurisdictions in which the company operates. But this has not been extended to other operators who also maybe they have got presence across the country, but then they are required now to pay service levy in each and every municipal, which it's not practical, and even if practical, it's quite expensive for companies. So there's a proposal also to consider the electronic money transfer businesses who usually have presence across the country, but so far they're not covered by that sort of simplified way of paying city service levy. So that's it for service indirect taxes in Tanzania. I will allow my colleague from Kenya to proceed.
Thanks, Elijah. My name is Michael Wachinga from PwC Kenya. So I'll be taking you through some of the Kenyan changes. So as collector mentioned, the finance bill for Kenya is out. It came out in May 2024. So some of the proposals that we'll be discussing here is what has been proposed to be introduced. Currently, public participation is ongoing. The request for submissions for proposals lapsed yesterday. Yesterday was the deadline. So from today up to next week, the Finance and National Planning Committee is receiving presentation from the public on the Finance Bill 2024. So I'll start off with the income tax one, and we've seen a proposal in regards to the digital service tax. So we are seeing a proposal to repeal the digital service tax from 1.5%, and the introduction of what's called a significant economic presence tax, which will be chargeable at 6%. So this will result in an increase in tax charge on these digital services, which if then the proposal was to go through, we might see an increase on cost on these services. We have seen as well a proposal to introduce what we are calling a motor vehicle tax at the rate of 2.5%. And this is to be charged on each motor vehicle, and it's based on the value of the insurance of the insurance cover, and it's based on the valuation of the motor vehicle. Ideally, the proposal is this to be collected by the insurance companies and remitted to the government. Something to note is that there are exemptions that have been provided for vehicles that are owned by the government or government parastatus, but for both passenger and commercial vehicles owned, they might get caught by this provision. Other proposals that have come through, we are looking at removal of certain exemptions that have been provided for income tax. We are looking at infrastructure and green boards, which have been largely exempt. Trust schemes and family trust, which has been exempt from tax, they are being proposed to be deleted. And therefore, what would mean if this were to go through, then income earned by this trust and family trust would be taxable, as well as infrastructure and green bonds interest earned there as well would be taxable. Another amendment that we are seeing coming through is in regard to definition of royalty. There have been quite a dispute around what constitutes royalty and what would be subject to withholding tax. In view of trying to correct this, there has been a definition amendment to include software licenses, training, maintenance, or support fee, including distribution, to be subject to withholding tax. So the implication of this, if it goes through, is whether you are paying for a right to use or you are paying for a copyright, then you would be expect that you will be caught up and withholding tax will be applicable. A welcome move that we are seeing is an introduction of investment allowance on spectrum licenses, where now telecommunication companies will be able to claim a 10% per annum allowance on the spectrum license. So that is a welcome move for the telecom industry. So moving on to the next slides, there have been some welcome changes around the employment tax, and this is around the tax exempt threshold for meal and non-cash benefits. We have seen those go up. For meals, the proposal is to increase that from 48,000 to 60,000. Per diem, the tax exempt threshold currently has been at 2,000 for the longest. So they are proposing to base that as a percentage of the employee gross salary. So the proposal is to have that at 5%. Another welcome move we are seeing is increase on the maximum deductible pension and non-occupied interest where you have an interest for mortgage. So they're proposing to increase both of these to 360,000. Pension over the years has been at 240,000 per annum. So that's being proposed to be increased to 360,000 per annum. And again, for mortgage interest, we're seeing a proposal to increase that from 300 to 360,000. So another welcome move we have seen is an amendment around the exemption for pension withdrawals. Currently, how the law is provided is that if you withdraw when you had achieved your retirement age of 65, then it's tax exempt. There's also a provision where if you withdraw when you have attained 50 years or you have been with a scheme for more than 15 years, then you are taxed at the wider tax bands. But if you withdraw below the 15 years, then that one is taxed. So we are seeing a proposal to have this amended accordingly, and this such that it's exempt if you have attained the retirement age as specified in the fund, or you retire prior to attaining the retirement age due to ill health, then again that will be exempt, and as well where you withdraw from the fund 20 years after registration date as a member. So this is a welcome move, but again there's an amendment to that. If you withdraw when you are below 20 years being a member of a fund, then that one is taxed at the narrow withholding tax rate, which is a welcome move. The last one of the other one that I want to touch on is from a tax administration. We are seeing where there's a proposal to increase the timelines within which you receive an objection decision from the Revenue Authority from 60 days to 90 days. Ideally, they are trying to increase the time with which the Revenue Authority would have to review where you have objected to an assessment and to give you a decision on that. From a data privacy, we are seeing an amendment proposed on the data management that would allow KRA to integrate, or the Revenue Authority to integrate their electronic tax system with the Revenue Authority. This is on the back of the Data Protection Act and the requirements on how you are able to handle data. KRA, there is a proposal to try and give KRA leeway on how far they can go to integrate the electronic tax systems with the taxpayer system. Another welcome move we are looking at is the exclusion of weekends and public holidays in determining the due date for submission of making payments. Remember, where, like I mentioned earlier, we are counting 60 days for which KRA should issue an objection decision. Currently, you have to include weekdays and public holidays, as well as where you are probably objecting to an assessment within 30 days. You count in the weekdays and public holidays that fall in there. And what that means is you might be short of time to respond. So there's a welcome amendment that is proposing to exclude weekends and public holidays. And what this would do is it would give taxpayers ample time to be able to either respond to objections or even to get determinations from the Revenue Authority. Moving on, I'll touch on a few for indirect taxes, and I'll start off with the value-added tax. There is a proposal to increase the threshold for registration from 5 million to shilling 8 million. There have been an uproar in Kenya that the below threshold of 5 million has been passed over time. It's not adjusted to inflation. And this is kind of to caution the small businesses from a compliance requirement to comply with VAT. A welcome move is the exemption of TOGC. As you're aware, there was an amendment that came through deleting the provision that was there before, kind of moving a transfer of business as a going concern to be taxable. So this is being reintroduced back to exemption. Again, there is an introduction of VAT on certain financial services. So they are looking at to bring to the ambit of VAT certain financial services. So we are looking at issuance of credit and debit cards, foreign exchange transactions, check handling, just to mention a few, where if the law is to pass, then these services would be subject to VAT. The other amendments introduced in the VAT Act, where they are proposing to delete some provisions that are some services and goods that are exempt and moving them back to taxable. And this is in line with the medium-term revenue strategy that had proposed to have a linear exempt schedule in the VAT Act. So we are seeing taxable supplies that are directly and exclusive use in construction and equipment of specialized hospitals, this being deleted from the exempt to taxable. Tourism and recreation of parks, again, that one as well being moved from exempt to taxable. Local film producers and local filming agents. So this is kind of trying to pump up revenue for the government by moving this from exempt to taxable, where now they'll be subject to VAT at the rate of 16%. Moving on to the next section, again, other changes that we're seeing is proposal again for a lean zero rating schedule, and these ones are being amended and moved to exempt. In some of the items we are looking at is agricultural pest control product, supplies of motor vehicles, etc. There are some welcome moves where there is some introduction of new exemptions in relation to mosquito repellents and input and raw materials used in the manufacture of mosquito repellent, tea packaging materials, micronutrients, among other items. But as well, we have seen an amendment again in relation to VAT and withholding VAT refunds. But this is to reduce the timelines under which you're supposed to lodge a refund from 24 months to 6 months. But this is ideally to align the provisions as per the VAT Act and the provisions as per the Tax Procedures Act. Moving on, I'll look at excess duty, but similar to the VAT, we have seen that there's a proposal to harmonize the excess duty rate at 20% for excisable services. Currently, there are various rates applicable, varying from 15% to 20% for money transfer services by financial institution or other fees by financial institutions. For betting, it's currently at 12.5%. So they're looking to harmonize all this and move it up to a flat rate of 20%. Again, they are looking to numb into the digital economy, where if you're providing accessible services and you're a non-resident through a digital platform, again, that is trying to be introduced to the ambit of accessible services. Again, we are seeing, as always, proposals that are touching the alcoholic and beverage sector. And this we are seeing is that they are moving from the current treatment where they base it at per litage of the product and trying to base it on the percentage of the alcohol content. I think from the previous presenter, you noted that the EAC is looking at to base excise duty on the alcoholic content of alcoholic beverage. So Kenya is moving in that direction. And the finance bill is proposing to have various alcoholic beverages excise duty based on the alcohol content. We are seeing again an introduction of excise duty on vegetable oils. This is likely going to pump up the price that will be absorbed by the final consumer for these vegetable oils, and that barely touches it on the excise duty. Moving on, we are looking at the next slide. A welcome move for the EAC partner states where such certain products that are imported from the EAC partner states, then they are exempted from excise duty, or there will be no excise duty applicable from them here. And this is to try to encourage trade within the partner states. So some of those items listed there, we are looking at eggs, imported onions, potatoes, potato crisps, and potato chips. So what this means is that if you're in Kenya and you import this from one of the other EAC partner states, then excise duty will not be applicable. So this is a welcome move because one, it is trying to encourage trade within the EAC partner states. Another amendment that we are seeing come through for excise duty, which is a kind of an welcome move, is a repeal on the relief or input excise duty incurred on raw materials for manufacture or bulk data for resale. To give context, is if you're a manufacturer of accessible products and you incur excise duty on the raw materials that you use, then you are allowed currently to offset your input excise duty on what you are charging on your final product and paying the net. Similarly, you buy bulk data for resale to final consumer, then you are allowed where you pay excise duty on the bulk data you purchase, you offset that on the excise duty you charge when you are retailing it to the consumers, and then you pay the net. So what would they mean is that if this was to pass into law with this provision, then you will not be allowed to offset the input excise duty you paid on what you're paying as output, as excise duty on the output, that is the goods that you manufacture. So they might have an implication either on the cost that is passed to the final consumer, and where manufacturers decide to absorb that cost, they need to reach an increase in their cost of production. Moving on, we are looking at the final bit, which is the miscellaneous fees and levies. We have seen a few proposals coming. There is a proposal to introduce eco-levy, applying on 46 items that have been listed under the first schedule. This is ranging from 98 Kenya shillings to 1,800 per unit. This would be on whether the items listed in that schedule are either imported or they have been produced locally. So we will see for this item, then there will be increase in cost, and that might end up being passed to the final consumer. Again, we are seeing an increase in import declaration fee from 2.5% to 3% on imported goods. What we are saying is that the reduction came last year. So it's only 1 year after that this is moving it up again to 3%. So we expect to see an increase on goods being imported. Again, lastly, we are looking at some exemption that have been provided on material from RDL and IDF on manufacture of mosquito repellents. You will see previously I touched on the VAT exemptions that have been proposed for these mosquito repellents and manufacture of those mosquito repellents as well. But now they are coming in and they are trying to exempt the same again from RDL and IDF. So in a nutshell, I think those are some of the provisions that have been proposed in the finance bill. As I mentioned earlier, it's currently under the public participation phase. So we expect that to be concluded sometime next week, and then the bill will be taken to Parliament. We'll be able, the budget will be read around the 13th of June. So we'll be able to see again what comes through the budget speech, but majorly it will touch on some of these items that have been proposed through the finance bill. So I'll pause it at that, and I think I'll hand over to our next presenter to take us through the Uganda presentation.
Okay, thank you, Michael. By way of introduction, my name is Patricia Chigundu, a tax manager in the PwC Uganda office. Here we'll speak on the proposed tax bills recently debated before the floor of Parliament and been passed. A few of the provisions awaiting assent by the President. I'll speak on the tax administration, which you're currently seeing now, what we call our Tax Procedures Code Amendment Bill. I'll speak on the income tax, the changes in the income tax and what's being posed under stamp duty. And my colleague, Juliet Najinda, will speak on VAT and excise duty proposed changes. So to start off, under the tax administration, the Tax Procedures Code Amendment Bill, there is an interesting one. For the bill is proposing a waiver of interest and penalties outstanding as at 30th of June if a taxpayer pays the related principal tax by 31st of December 2024. So for instance, if you have a taxpayer who has principal tax due, for instance, for withholding tax and related principal tax, for instance, of 10 million, and maybe related interest and penalties of 6, then if that taxpayer pays the principal tax of 10, then there is a waiver of interest and penalties can be sought from the commissioner, and that can be approved. The process is pretty straightforward. It's a voluntary disclosure submitted to the commissioner, and approval is usually given. But again, we saw that this kind of relief being provided in 2023, where government collected as much as possible of taxes in respect of this voluntary disclosure window. And it was a big relief to a number of taxpayers. So we understand that this proposal has been adopted and accepted. So we await to see what will be assented by the President. The second proposal, and this forms the last one under the Tax Procedures Code Amendment Bill, is the introduction of a requirement for a taxpayer who is intending to claim a deduction of or a credit for goods destroyed as a result of damage, expiry, either of trading or manufactured goods to inform the commissioner in writing prior to destroying those goods. So in this case, if such a taxpayer doesn't get that permission from the commissioner, then
Yes, sir.
Sorry, let me proceed.
Oh, the pulka. Oh, thank you so much.
I think I've been muted. Sorry, I was muted for a bit there. So yeah, so where we had left off. So if the commissioner has not approved or no permission has been sought by such a taxpayer, then they cannot claim a deduction from an income tax perspective. And the intention here was really to streamline the procedure to follow before claiming a deduction or credit of goods destroyed in respect of excise duty remission on imports and VAT refunds. However, we're just wondering how this will, it may pose a practical challenge for a number of taxpayers to request the commissioner to approve for each stock or goods they have to destroy as a result. So we anticipate there may be some delays here and there, but now what we understand is that this provision or proposal has been passed by Parliament. So I'll now move on to what is in the Income Tax Amendment Bill, quite a number of provisions. And I'll just quickly run through, considering that we have some time constraints. So the first proposal, and which was quite interesting, that caused a public uproar, that caused public noise in the country, is in respect of the proposal to introduce capital gains tax of 5% on gains derived from disposal of non-business assets. So the exclusion here in respect of that proposal is only in respect of involuntary disposals through auction or divorce settlements, etc. But here, what they were trying to target were non-business assets that include disposal of shares of a private company, the land in cities or municipalities, except a principal place of residence, and rental property subject to rental tax. So again, just to add a little bit here, in the past years, we've seen the government trying on several attempts to introduce taxes or tax on proceeds or gains derived from disposal or transfer of assets. And for some, they were successful. For instance, in 2019, they introduced a 6% withholding tax on purchase of business assets from resident persons. In 2023, again, there was an attempt to introduce withholding tax of 5% on gross proceeds derived from sale of an asset. This failed at that point in time, and it wasn't passed in 2023. Now, again, in 2024, there is a proposal for CGT or capital gains tax of 5% on gains derived from disposal of non-business assets. We understand from the different debates and the noise that has been caused, this has been rejected by Parliament on grounds that it may cause an overall tax burden to a number of taxpayers, and it may increase the cost of doing business in Uganda, yet land is a major cost of production, among other reasons. So this has not come through the acts, awaiting the assent of the president. And again, this was a welcome move by Parliament. The second one that I'll touch on is the proposal to remove the term called branch under the Income Tax Act and replace that with the term called permanent establishment. You may be familiar with this term, and the intention here is to align the Income Tax Act to the Double Treaty Agreement Treaty Policy and the EAC Model Double Treaty Policy. So for quite a number of years, we've never had that in our legislation, but now this has been proposed to be introduced. So again, the questions around here, what does this proposal mean for a person who has a branch? It means that, one, the bill is providing guidance on what business activities by a non-resident would trigger a permanent establishment in Uganda. Two, the bill, again, when you have some time, you look at it, it's proposing a new calculation for profit attribution rules in respect of PEs by providing guidance on what is chargeable income that relates to a permanent establishment. And this, again, when you have a look, it differs from the current computation for branches in a way that, for instance, chargeable income, and what includes chargeable income is basically the gross income of a permanent establishment would include only fees, only activities that are based in Uganda, but then it excludes fees that are charged by a permanent establishment to a head office, such as royalties, commissions on services, interest on loans, etc. So just to mention a few there, but what we understand from the different discussions before the floor of Parliament, and the act that is awaiting assent by the president, this provision has been passed. The third proposal that you see there under bullet 3 is in respect of introduction of 2% withholding tax on gross interest payments made to a non-resident in respect of debentures on satisfaction of certain conditions. For instance, is the interest paid by a resident person to a financial institution, etc. Just in simple terms, and to give a little bit of background, a debenture in simple terms means an instrument that acknowledges indebtedness. So such things like mortgages, mortgage stock, loan stock, etc. So here the provision here is to, the proposal here is to include or introduce 2% withholding tax, which is not currently in our law. That was been excluded for a long time, where you find that if someone is paying interest to a financial institution of public character or a non-resident person, then that would be exempt from withholding tax. So from a number of debates before the floor of Parliament, etc., we noticed, or we found that this has not been passed. It has been rejected by the floor of Parliament on grounds that it would discourage the flow of capital into Uganda, which currently is critical for Uganda's economic transformation. So the fourth one you see there under bullet 4 is the proposal to introduce 10% advanced withholding tax on commission paid to payment service providers. By way of example, these include bank agents or other agents offering financial services. For a long time in our current law, those were they have been exempted from tax, but now there is an introduction of 10% on services that are provided by those payment service providers. So again, here what we understand the amendment is seeking to align this rate to all banking services and to all banking agents and telecom agents. Currently, the telecoms are falling under the 10% as well. But government is saying that it's high time for the banking agents, because they provide similar services, to also fall under this bracket. We understand that this proposal has been adopted and passed. Again, we are waiting to see what will be signed off by the president. The fifth one, under what you see there under the fifth bullet, is a proposal to exempt certain incomes from income tax. This comes in every year for specific kind of incomes or specific kinds of projects. This time round, there is a proposal to exempt income from disposal of government securities on a secondary market. Here, secondary market means investors who buy and sell securities through the Bank of Uganda accredited commercial banks. So again, here it's intended here really to boost or encourage more investments into Uganda. The second proposal is to exempt income from disposal or from this income from strategic investors in electric vehicles and parts. And yeah, you'll see this across all different kinds of bills, specifically for electric vehicles. And mainly it's to encourage these kinds of projects into Uganda, but also to encourage investors to invest in this. So what that means is that such income from investors in respect of electric vehicles and parts will be exempt. The next one, which we also wanted to touch on, is income derived by or from a private equity or venture capital fund. And these are regulated by the Capital Markets Authority Act. And here really across all the bills, you'll note that there is a specific exemption for that, and mainly to encourage the growth of early stage investment as soon as possible, but also it will have a positive impact on employment and overall grow the economy. So the last one in terms of income tax is the proposal to expand the definition of retirement fund to include funds maintained for provision of benefits to their members upon termination of employment. So currently what we have is the definition is restricted to provision of funds to members or dependents upon retirement or death of a member. So here they have expanded that to include if a member has been terminated from employment. Again, this is a welcome development, and what we understand that this amendment has been, or proposal has been passed. So I'll quickly move on to the changes in the stamp duty amendment bill. And these are few similar to what we've been saying in income tax for those specific projects. One, there is a proposal to remove stamp duty on nominal share capital held by a private equity or venture capital fund under the Capital Markets Authority. So that, again, largely that as we noted previously, the intention here is to encourage access to cheaper capital, early stage investments, etc., that will grow the economy and overall the employment. But again, here they, as similar to income tax, they are also suggesting a nil duty rate or stamp duty rate on the private equity and venture capital kind of investments. So yeah. So the second one and the last one is again on those strategic projects that we've talked about. I mean, there is a proposal to introduce nil stamp duty on certain instruments executed by a manufacturer of an electric vehicle, electric battery, vehicle charging equipment, etc., including other strategic projects that we talked about. Here, the catch is there are certain kind of conditions or that have to be met before that exemption is granted. One is in respect of how much the capital investment is. For instance, if the capital investment from a foreigner is $10 million, then they may have that relief, $150 for citizens, depending on where the investment is placed, and if it's placed outside the boundaries of Kampala, then the exemption will apply. Other conditions we've seen is where they employ at least 80% of Ugandans, and those 80% of Ugandans have to at least earn 70% of the total wage bill. So that's it from an income tax and stamp duty perspective. I'll call on to my colleague Juliet Najinda to speak on what's in VAT and excise duty. Thank you.
Thank you, Patricia. Good afternoon, ladies and gentlemen. So I'll just quickly take us through the amendments from an indirect tax perspective that's covering VAT and excise duty. So like Patricia mentioned, the tax amendment bills in Uganda have already been passed by Parliament. So we know what has been approved by Parliament and what has been rejected. We are waiting for the President to assent to the bill so that we can get a confirmation of what we should expect to take effect from 1st July. So from a VAT perspective, the first proposal that we have is around an introduction of an obligation for recipients of proceeds from auction arrangements. The first proposal is for people who receive proceeds from an auction arrangement to account for VAT on those proceeds. And here what the bill is trying to achieve is for cases where you have auction goods. Previously, we have seen the law being amended to require auctioneers to have the obligation to account for VAT. But then we found that once that law was passed, it was rendered redundant because in most of those auctioning arrangements, auctioneers are really brokers to that transaction. They are not the ones who actually make the supply for the goods. So this amendment is now coming in to shift back the obligation for auctioning arrangements for the obligation to be with the person who receives the proceeds, who would actually be seen as the supplier of that good that has been auctioned. Then the other amendment that we see is around the proposal for goods that are supplied under self-supply arrangements by employers to their employees, for those goods to be subject to VAT. This was already happening, but now we are seeing that the law is coming out clearly to specify that if, for example, you are a beer company and you have to supply beer and you give your staff beer, then you'd be required to account for VAT on that beer, which we normally call self-supplies from a VAT perspective. Then the other proposal is around the requirement for people who apply for cash refunds to have hit at least a credit offset of 10 million Uganda shillings. Previously, you could only apply for a VAT refund if the cash offset that you had in your VAT return, which is as a result of your output VAT minus your input VAT exceeding being at least 5 million shillings. So now we are seeing that threshold being increased so that then taxpayers can only apply for a cash refund if your credit position is at least 10 million shillings. To the extent that what you have as an offset position is less than 10 million shillings, then you cannot apply for a cash refund, but you can carry that credit forward and offset it against future liabilities. Then the other proposal is around the introduction of a penalty for people who fail to withhold VAT. And the penalty that has been proposed is in the form of the agents who have failed to withhold VAT to have the obligation now to be the ones to pay the VAT which they ideally should have withheld. The only thing is that this proposal then allows such a vendor to recover that VAT that he has paid on behalf of his vendor from the vendor from a subsequent transaction. But we know that this is one of the proposals that has been rejected by Parliament on the basis that it's already a big obligation to have companies take on the obligation to withhold VAT. So burdening them with extra penalties would be, you know, a big, an uncalled for penalty. So we don't expect this to come through. Then the other amendment to the VAT Act has been around the exemptions that we have seen, to things like agricultural products like hose and pesticides, fertilizers. Previously, these have been zero rated, but now there's a proposal to move them to the exemption schedule so that they align with the rest of the items in the VAT Act, the agricultural items that are generally exempt from VAT. Then we've also seen a proposal similar to the other proposals that the other exemptions in income tax that my colleague Patricia talked about. We're also seeing an exemption for the manufacture of electric vehicles, and as well as the accessories that move with that. And again, this now comes in to encourage that industry. We currently have a company in Uganda that manufactures electric vehicles, so the exemptions are coming in to encourage that factory, but also to encourage more players to join that industry. Then from an excise duty perspective, we have seen some interesting proposals that are going to affect us as people who use the things on which excise duty has been levied. The first one being around the proposed increase of excise duty on fuel, that is on petrol, diesel, as well as kerosene. So the proposal is to increase excise duty by 100 shillings for both diesel and petrol. And we are aware from the discussions with Parliament that this has been upheld. And then there's also a proposal to increase excise duty on kerosene from 200 shillings to 500 shillings. However, this was rejected by Parliament on the basis that kerosene is used by people in rural areas that do not have the luxury of accessing alternative fuel options. So increasing excise duty by more than 200% would then be very detrimental to the rural communication. So the rural community. So we don't expect that proposal to come in on kerosene. But the other two on diesel and petrol, we expect those to come through because they were approved by Parliament. Then we have also seen a proposal to introduce excise duty of 500 shillings per kilogram, per 50 kilogram bag on some of the items used in construction like grout, white cement, and lime. Previously, we have had excise duty on cement in Uganda, but now we are seeing that the scope is being expanded to other items that are within that same family of cement, like grout, white cement, and lime. And this has also been approved by Parliament. Then we've also seen a proposal to introduce a 0.5% excise duty on withdrawals of cash provided through payment systems. And here we know that this proposal is targeting payment systems like Cheaper Cash, Wave, because currently in Uganda, we have this excise duty of 0.5% applying on withdrawals that are made through mobile money. And the interesting thing about this tax is that this 0.5 is not on the withdrawal charge that is charged by the telecommunication company or the payment system provider, but it is on the value of the money that you withdraw through that payment system or through mobile money. So the scope has now been expanded beyond telecom money withdrawn through telecom networks to now money that you withdraw through payment systems. But there's an exclusion, there's an explicit exclusion following debate of this proposal by Parliament to exclude agency banking transactions. And here in Uganda, agency banking is facilitated by financial institutions. So it's an extension of financial institutions. So this 0.5% will not affect withdrawals done through agency banking. It will only be limited to payment systems that were not previously being captured in the current law. Then we also have another proposal which is looking at extending excise duty exemption on incoming calls from Tanzania and Burundi. Currently, when those calls are coming in from Tanzania and Burundi, we have an excise duty of $0.09 per minute that is charged by the telecom companies. But this proposal is now coming in to exempt the incoming calls from excise duty so that the exemption is aligned with the other countries in the region, like Kenya, where this excise duty does not apply. Then we've also seen a few exemptions similar to what we've seen in income tax and excise duty. And this is on construction materials of an electric vehicle. Again, this is just to promote that industry for people coming in to support, to build electric vehicles and assemble them. But then we also have other exemptions for strategic investment projects subject to the investors meeting certain thresholds, investment thresholds. So that's it from a Ugandan perspective. I'll now invite my colleagues in Rwanda to take us through the changes that we're seeing that side.
Thank you, Juliet. Good afternoon. My name is Maurice Magama from the PwC Rwanda office. I'll be presenting some of the tax developments from Rwanda perspective, and I'll be presenting together with my colleague Emmanuel Mlawa. So just to start, as Ibrahim has introduced, so in Rwanda we are having a bit of a different approach when it comes to tax changes. So our budget is more of a fiscal policy and some of the macroeconomic indicators. So it doesn't introduce the tax changes. So the tax changes are mainly introduced by the Ministry of Finance and through the ministerial orders, which are usually issued once and when needed or required. So what we have tried to do is having some of the recent tax development that have been happening, but some other changes that we see they are about to come through our what we call medium-term revenue strategy, which runs for 4 years. So some of these changes are part of that strategy. Now, for interest of time, I will quickly touch on the few developments. Starting with the income tax, we have a reduction in the corporate income tax rate from 30% to 28%. And this is in line with the medium term revenue strategy, which aims actually to reduce this rate all the way up to 20%. As you know, Rwanda is trying to become a regional hub in terms of attracting businesses and investment. So we are trying to put some tax environment to be more friendly, and in doing so, reducing corporate income tax is one of the key change that will tend to motivate business and investments to come here in Rwanda. The another change is in relation to VAT. We have taxation of digital supplies. So this has now been mentioned as part of the VAT. As part of the taxable supplies, we have also digital online services. It has not yet imposed the modality, so we are waiting for the ministerial order, which will come and provide the guidance on how those digital services will be taxed. We have also exemption on the transfer of asset between related parties in the context of group reorganization. So if the two entities that are tax resident in Rwanda tends to have a group reorganization, which also includes transfer of asset, then that transaction is exempt from VAT. There won't be any VAT applicable. But another one is zero rating of VAT on electric vehicles. So this as it is, it's just a move to motivate people moving from the normal fuel and gas vehicles and all the way to electric vehicles. So for the locally assembled vehicles, VAT has been zero rated, but also for the imported electric vehicles, VAT has also been exempted. So we don't have VAT. So we expect this will reduce the cost of the vehicles and encourage people to move away from the gas and fuel vehicles which have been using. In the same spirit, the excise duty as well has also been exempted from the electric vehicles. Another thing is we have seen some recently ministerial orders. The first one is in relation to tax voluntary disclosure, which aims at first motivating people to become more compliant, but also to boost revenue collection. So this window has opened from March to mid of June. So taxpayers are encouraged to do their self-assessment of their tax affairs, and where they find there is any area of non-compliance, then they are encouraged to voluntarily disclose to the revenue authority, and then there will be an automatic waive of interest and penalties. So currently the taxpayers are exploring this window, and it has been a very good and recommendable move by the revenue authority. We have also a ministerial order which sort of produce or give guidance on claiming of input VAT on imported services. As we know, the input on imported services is usually accounted on reverse charge mechanism, where you disclose your output and an input VAT. Now, in Rwanda, for you to claim the input VAT, you are supposed to have an approval from the Ministry of Finance. So it kindly give a confusion before, where there was no guidance on how you can claim the input VAT. But now the introduction is once you have an approval from the Ministry of Finance, then you can go ahead and claim the input VAT. Although before getting an approval from the Ministry of Finance, there are two steps which you have to go through. First, you need to publicly advertise your tender. And then you need also to go to the ministry or regulator who is responsible to your sector to get an approval that whatever you are trying to import from outside is not locally available. And the last step is where now you go seeking for approval from the Ministry of Finance. So once you get that approval, you can direct claim your input VAT. And the last thing is VAT reward system. This has been introduced to final consumers, a 10% VAT rebate, which aims at motivating individuals to demand a physical or tax receipt. So if you go and do your purchases to a locally tax registered person, is supposed to issue with a physical receipt. Now, most of those suppliers, most of the time, they don't tend to issue a receipt. So the Revenue Authority has introduced this rebate VAT reward. And once you have registered yourself with the Revenue Authority, they will give you a code. And when you go and do the purchases, you give a code to a supplier. And when he's issuing a receipt, then he will enter your code. So once he enters your code, then automatically 10% of the VAT on the purchases you have made, it will go to your account and it will be a reward to you. So these are the few, in interest of time, these are the few changes that we have seen, and my colleague Emmanuel will go ahead and present on some of the other changes that we anticipate will be coming in the future. Thank you.
All right, thanks, Maurice. Hi, everyone. So my name is Emmanuel Mlawa. I'm a senior associate in PwC Rwanda in the tax line of service. So as Maurice has said, Rwanda, we do not have a typical budget process. And most of these tax changes, they're triggered, or they're rather documented first in the medium-term revenue strategy. And then later on, we'll come and see the cabinet sit down and then trying to implement or bring new laws or other changes to the laws, which align to the medium-term revenue strategy. So my colleague Maurice has presented what was there in a medium-term revenue strategy, but that has already been legislated, or rather they have been developed to a law. So now I'm gonna go ahead and present other tax changes that are there in medium-term revenue strategy, and we expected them to be implemented in the near future. So as Maurice has put it very well in item number 1 in income tax, so we've seen a reduction already of income tax rate from 30 to 28, but medium-term revenue strategy is planning to reduce the rate all the way to 20%. So we are expecting to see gradual change, or rather gradual reduction of the CIT rate all the way to 20% in the future. And other than that, we are also will also be expecting to see phasing out of a number of incentives that are there in investment law. So in Rwanda, we have this investment law, or rather code, which has posed a number of tax incentives to investments in a number of priority sectors. But the argument is the government does not see a lot of revenue gains compared to what has been lost by issuing of those incentives. So what we're expecting to be seeing in the near future is the reduction of CIT rate to 20% and the phasing out of the incentives in the investment law. Another thing is introduction of minimum alternative tax. So the argument behind it is a lot of multinational entities, they tend to do what we call base erosion. So to avoid that, to avoid the revenue authority to lose some taxes on the profit, they are planning to introduce the tax on the turnover to be charged to those entities that will be making losses, to compensate for that. And another change that we'll be expecting is the introduction of immediate expensing of capital investment to replace depreciation, and this goes together with getting credit of it, or rather getting allowance to carry forward tax losses. So in Rwanda, we have this restriction, or rather a cap of carrying forward tax losses of 5 years. So what we are expecting to be seeing, which has been documented in MTRS, medium-term revenue strategy, is the law will be changed to allow immediate expensing of capital investments. And this is pretty much to encourage investment in those sectors that require huge investment. And then, as we know, most of us know that immediate expensing of capital investment will definitely cause tax losses, because we do not expect new investments to be making profit at the beginning of the investment. So to go with that, we will also see a change in the cap of carrying forward tax losses. We'll be expecting that to be removed. Another change in the VAT bracket is we'll be expecting zero rating of VAT on construction of residential houses. So the basis behind this is that Rwanda is trying to encourage construction of affordable housing, and so the MTRS is planning to either exempt or zero rate a number of construction materials to boost investment on that sector. Another, actually the last change that we'll be expecting is the increase in excess duty on older vehicles to incentivize and upgrade Rwanda's fleet. So as my colleague Maurice has said, and regarding one of the changes that have already happened is the zero rating and exemption of VAT on electric vehicles. So that goes hand in hand with this one, whereby we'll to discourage the dumping of old vehicles in Rwanda. We're expecting MTRS, we're expecting the changes in the law, whereby they will be pushing for higher excise duties on other vehicles. And already now we have the exemptions on the electric vehicles. So for a number of people to be moving from the normal vehicles and move ahead to electric vehicles. So I think that's it for Rwanda. I'll hand it over to Ibrahim Wele to proceed. Thank you.
Thank you, everyone. So I think, Adrian, back to you.
Okay, thank you very much, Ibrahim and colleague, for giving us the insight on the tax proposal for Tanzania, Uganda, Kenya, and Rwanda, as well as the comparison of the domestic tax regime across the EAC region. Now is open to discussion, and we are inviting the questions where maybe people want some clarifications and more information. So you raise your hand, but when you are given chance, please be very brief, and you can say where you are directing your question. Oh, okay, Edie, you can start the discussion because I can see your hand is up.
Yeah, I wanted to thank the presenters. Sorry, I wanted to thank the presenters for sharing their insight, and perhaps maybe what I didn't hear from all the presenters, the implication on investment, our FDI, CBI, what are these measures mean to investors, both local and foreign investors?
Okay. Maybe we can have another 2 to 3 questions.
I see our board director Wabogo raising his hand, Adrian.
Yes, yeah, director from Uganda, please come.
Yeah, good afternoon, everybody. I again add my voice to CEO to thank the presenters. I think now this has been country specific. And from EABC perspective, adding the voice to what CEO has raised on attracting investment, when you look, there is a lot of disparities in terms of the domestic taxes. And the objective is to look at how do we harmonize these taxes, because we're looking at one regional market. So we in private sector, our aim is to make sure that the level ground is well leveled so that there is intra-trade is increased. But the moment we see a lot of disparities, even in domestic taxes, that also acts as a barrier in terms of trade. So I would like to see these people having country specific. How do they put their head together to guide us as EABC, as an advocacy group, on how to fast track the issue of harmonization of domestic taxes? Thank you.
Thank you very much. I think also we have Nyantai. Can see, Doctor. I think Mr. Nyantai is struggling. Hila.
Yeah, thank you very much. This is Hillary. I don't know why it's coming as Hila. So good afternoon, everyone. Hillary is my name. I work for the Eastern Africa Farmers Federation. First, would I also want to thank the presenters. Then very quickly, my question would be, as we look at this harmonization of the different taxes across the region, my worry is on the users of this opportunity, the private sector. I think I look at it from the background that anytime there are these discussions, you find the private sector left aside. So my question is, what is the plan to formalize and have this local level private sector engaged and utilize these opportunities? Thank you.
The last one.
Hello, can you hear me now?
Yes, Nyantai, Doctor, we can hear you.
Yeah, so I have just two quick points. Thank you very much for the very good presentation on the various countries. Of course, I'm curious to know what about the other members who have not presented, Burundi, particularly South Sudan. I can understand the two others which have just recently come in, maybe they are putting the house in order. But my two quick points related to year after year, we always see these disparities amongst the partner states. And I would have expected the EAC to move so that there is convergence. I mean, because sometimes, of course, you find we make improvements and then countries go back and all that. And as a region, if we are integrating, shouldn't there be some sort of deadline or some timeline so that given a few years down the road, we should really be one region, just like you have been discussing the ECT and things like that. You know, that's my thing. That's one thing. The second point is in terms of timelines to the budget. It is very unfortunate that you find some of the partner states leaving the presentation or the sharing of the finance bill until very, very late, and it makes a mockery of all the consultations that we want to do. Why can't they all agree that maybe by March or by April, all countries must already have the positions known, discussed, and therefore we can talk of integrating? Thank you.
Okay, thank you very, very much, Doctor. I think we can get a response from the PwC, where we start with the implication of those tax measures or changes to investment, but also we need to respond on the issue of disparity in the domestic taxes and how EABC and the private sector in general can fast track the harmonization process. But also Hillary raised the issue where the private sector, especially the local private sector, can participate in the consultation and influence the budget. And actually, Dr. Nyantahe had some challenge in terms of inquiring how private sector can get the tax measures for Burundi, South Sudan, and DRC as their member also of EAC. And the last one was on the, can we have a timeline in terms of harmonization of domestic taxes? And can we agree on the time for the pre-budget consultation and when the budget actually should be read? Because in some countries like Kenya, you find you have a leeway where you can influence the budget after the budget bill. The same apply to Uganda. But in Tanzania, for example, it becomes very challenging because the bill come very closely to the day where the budget is going to be unveiled. Back to PwC in terms of the response to those questions.
Okay. Thank you, Adrian. So I'll start responding, and particularly on the issue which are more of a tax related, and starting with the impact of these move in terms of the tax proposals and its effect in FDI, and also I'll touch base on the concern around the how we can harmonize the budgeting process and all that stuff. And then there's a concern on harmonization that Adrian probably you can also chip in. But starting with the effect of these different measures and its effect on the FDI, I think generally if you look at the way that in terms of the Tanzania, the proposal that are being presented, and in terms of the finance bill, what has been included for countries like Kenya, Uganda, and then the move by the Rwanda, you tend to see most of the time the aim, for example, in Tanzania, there's been a progressive reduction of SDL rate, which effectively feeds on the effect on the how expensive it is to invest in Tanzania, because at the end that's a cost to an investors. But also other aspects that probably didn't touch base on because they are more of industry specifics around for example, for the mining, how the rules are currently in terms of the deductibility of the royalty, CSR, and all that stuff, which effectively feed in on the return to an investors, and in a way impacts the investors' decision in the countries. And as been presented by Randy's colleagues, you see they have a plan to make sure that the rate get reduced for corporate income tax rate. The rate has been reduced from 30 to 28, and seems as part of the medium-term revenue strategy, they aim to further reduction of the rate. So I think the political will to some extent is there, but the challenge is the balance between how you balance the long-term value and the short-term need of having these revenue returns to make sure that you sort of cover for your budget in terms of what you have as an expense. So it's always a challenge with developing countries. Most of the time changes in the tax law as much as they impact the FDI, but its impacts tend to take time for it to be reflected. So I think if you ask my view, we are heading towards the right direction. Probably the issue will be in terms of the pace, in terms of these changes are happening, and if really there's an harmonization across all East African countries, which is not the case in most of these domestic taxes. So that's really an area of concern. But I think every country in its own it's really trying to see how progressively or it can make changes that have a positive impact on the investment to their respective countries. So that generally will be my response. And then touching base on the issues, I've said it's the situation is kind of better off in Uganda and Kenya in terms of the timing of the finance bill, because in Uganda, you tend to find they have 2 to 3 months to discuss those issues. For Kenya, they have 1 to 2 months also for discussion. The only issues here, for example, for this, it's for Tanzania, which kind of only have 2 weeks. So say this is a matter of a policy, and it's an issue as stakeholders we have been trying to push, and hopefully this is something that they are going to consider after some time. So those will be my response. I mean, if there's anyone else from the PwC team also want to sort of chip in before Adrian address the issues around harmonization.
Thank you, Ibrahim. I would want also to add some, a bit from a Rwandan context, especially in terms of investment. As I mentioned earlier, we have seen a lot of efforts here in Rwanda, especially from the government side, try to make as friendly as possible the investment environment here in Rwanda. And that's why you see a movement of reducing the corporate income tax, a movement of removing some of the taxes, VAT and excise duty on some of the businesses like electric vehicles. But also we have seen an introduction of an investment code. That investment code inside it has a lot of incentives to new investment, and to some of the sectors, let's say like for corporate tax, the rate goes all the way up to 0%. So with the aim of encouraging investment to come to Rwanda, and we have seen many FDIs coming to Rwanda now. And it's because of that investment code. So it even give incentives to some of the employment costs, like the labor, the visa, and everything that the investors is cost to the investment. It has reduced significantly. Even for more heavily capital investment, we have seen an introduction of an accelerated capital depreciation, where you can claim up to 50% initial allowance to some of the heavy machines and capital that are imported to the country. So it's a move to attract more investment, and hopefully in the future we can see more investment coming to Rwanda. But also my view in relation to harmonization of some of the taxes across the East African countries. I think this has to, because tax is not a separate component. It is part of the country's policies, physical policies. So each country has its own short-term, medium, as well as long-term. It has identified key priorities that they want to achieve. And now it's from those priorities where now you develop the tax policies and the tax changes towards those policies. So the first move would be first to have we can't have common goals, but at least to harmonize some of the macroeconomic goals. And once we have that harmonization, then it will be easy also to kindly of chip in with the tax changes that have the same direction to the those goals that the specific countries tends to achieve for the period that they've given to themselves. So that would be my comments from the Rwanda perspective.
So my comment. I think we don't have more comments from PwC, but actually I see one hand. Is it Aloysius? Hello?
This is Aloysius Chitengo. I'm from Uganda.
Yes,
and I work...
Chitengo, can you talk?
This is Aloysius Chitengo, and I work
From
with EAC in Uganda.
Okay, maybe you...
Hello? Adrian is speaking, he's speaking, allow him to speak.
I was
okay,
saying
I
that,
think Chitengo has some challenge because you can't hear him speaking.
I can hear him.
We need now, because of the time, what I can promise you, we are going to share the presentation to all participants of this workshop.
Adrian, we
but
can hear
please make sure that you are alerted in terms of participating in our future webinar, which will be aiming at enlightening you in terms of various tax measures. But also we are going to do analysis after the budget, after reading of the budget, where we are going to compare what is being proposed and actually what has been effected, and we'll show some of the implication of those new tax measures across the EAC partner state, which will read their budget this June. So I invite the executive director to thanks and close the workshop.
Yeah, thank you very much, Adrian. And I want again to thank all the yes. I'm speaking, Adrian.
Yes, we can hear you, but from far.
Oh, am I audible? Nyantai, Dr. Nyantai, able to hear me?
We can hear you now.
I can hear you. I can hear you, Idi.
Okay, thank you very much. I wanted to thank the PwC team, led by Ibrahim, and really for a good presentation and insight on various tax measures. And I want also to thank our board directors, Ruawogo, our Goodwill Ambassador, Dr. Nyantai, and all the participants from the region, especially for their inputs, their questions, their insight. And I think, as Adrian said, our role is to gather all the views, all these measures, and come up with a clear recommendation to inform our members in terms of the implication. So as Nyantai highlighted, I think our interest is convergence and not divergence. And we've seen that there is a lot of divergence among our partner states. And our aim is to ensure there is harmonization, there is alignment, there is consistency, there is predictability, there is certainty in taxation. So what we've received, really, there is a lot of divergence, and we need to work towards convergence. And as I mentioned in my opening remarks, we've been arguing partner states that are not ready under this exercise, South Sudan, Democratic Republic of Congo, the Federal Republic of Somalia, also to fast track their process of aligning their fiscal year with the EAC, other EAC partner states, so that we're able to read the budget at the same time. So from the EABC board directors and from the chair and everyone, I want to really to thank PwC, and we look forward for the post-budget analysis, especially in areas that we've highlighted: trade and investment, aspect and business environment in general. How are these measures really supporting the recovery from the global financial crisis and other crises that have impacted heavily our region? So we need to ensure that a tax becomes an input to productivity, not a hindrance to the business environment. So again, I want to thank everyone, and I want to close this webinar. Thank you very much, Asanteni sana.
Thank you very much, Idi, and thank everyone. Asanteni sana.
Thank you.
Thank you.
Thank you.
Bye. Bye. Adrian.
Thank you.
Yes.
Thank you.
Thank you very much.
Thank you.
Thank you.
Thank you very much. Dr. Abdallah Makame, you are in.